Hello, everyone. I am Lane Lowry with Acqua QOF Portland. We're a multifamily opportunity zone fund, and the presentation today is Reinventing Opportunity Zone Funds, Strategies for Post-COVID Success. We are not giving tax advice. We'll provide a disclaimer at the end, but we're going to be providing a lot of ideas about how to operate an opportunity zone fund, and it should be a lot of fun. We are in Portland, Oregon, and sort of by accident, we discovered that our main project was in an opportunity zone, just a few blocks from the central business district. And we discovered that we were rated #1 out of 8,760 opportunity zones by Smart Growth. And the area itself is rated #5 by the National Apartment Index by Marcus and Millichap. So it's growing, it's improving, and we have lower costs than most of the major West Coast cities. So we're an in-migration location that's been achieving a lot of growth over the last few decades. The Opportunity Zone Fund program, we're focused on real estate, is a Tax Cuts and Jobs Act program that establishes 8,760 opportunity zones where an investor can invest their capital gains into the fund, an LLC or a REIT, and they can defer tax for the invested capital gains. So they have up to 180 days from when they close a transaction to invest, or at the end of their year. And then because of the CARES Act, there's been some changes. Now the Opportunity Zone fund has to make some investments, has to improve some real estate or some businesses in order to qualify. And either improving real estate or buying real estate just before it goes into service. This provides the investor an opportunity to avoid paying tax for 7 years. They get a discount on tax if they stay in the investment for 5 years. And then for each of the years, they receive tax deductions. And after holding the investment for 10 years, the capital gains are eliminated. This is what's commonly known in the industry that people are familiar with. And what we have done here is shown a simple timeline. If you make an investment in the QOZ in 2020, you can defer your capital gains. And then in 2027, those capital gains taxes would be due with a 10% discount. And then in 2030, there'd be a markup to fair market value of the real estate, which eliminates the tax on capital gains. Again, this is what everybody is familiar with. And we're reinventing the Opportunity Zone timeline by introducing the CARES Act with NOL carrybacks. So you can go back to 2015 with your losses. We're showing how to use depreciation. So in 2020, by investing in investment that has depreciation, you can receive that. In 2030, there's a markup to fair market value, and it could even continue as long as 2047. Now, the CARES Act has provided for net operating loss carrybacks for 5 years. Now, income that is received as active income or losses in the 2020 year could be carried back to your passive years. So if you're a real estate professional, which is an active investor, just in the year 2020, you could carry those back to previous years and even get back some of those taxes that have paid in the pre-Tax Cuts and Jobs Act years at a higher rate. Also note that Section 165I disaster losses, those can be carried to 2019 and then back to 2014, okay? So it's important to look at every single opportunity to find losses to carry back 5 years. This is a benefit from the CARES Act. Now, 1231 property gains, there's been some big changes in the final regulations. Typically, if a person makes money in 1231 gains, they would then have to net those out. So you'll see in the past, you have to net your gains with losses. An example would be you have 1 million in gains, you have 1 million in losses, would give you 0 for investable gain. Presently, you can invest separately and use your losses elsewhere. So if you put $1 million into an Opportunity Zone fund, then you'd pay 0 tax at that time, and you'd have 1 million of 1231 losses in this scenario to use against your ordinary income. Now, in the past, you would net out capital gain with capital loss. In this scenario, you get to move your capital gains forward and use the losses against ordinary income. So it's very important. A lot of people are potentially able to capture over 100% tax savings in the first year, and we'll show you more about that later in this presentation. Now, original use assets, the final regulations have changed original use assets. It's a vacant property or a newly constructed property before lease up, which allows for operating deductions in the first year and bonus depreciation, which can be special allocated, meaning you can give it to different partners at different amounts. Depreciation is one of the major benefits in an opportunity zone fund. There are 5 and 15-year property that can be cost segregated. Also, qualified improvement of property is now allowed to be depreciated for the owner, the investor. Qualified non-recourse financing is the key. When money goes into an opportunity zone fund, those capital gains have zero basis in the fund. However, the investors, if they are receiving qualified non-recourse financing as basis, can then use that to take bonus depreciation. It's 100% up till 2023. Now, once the 10-year hold period and the minimum 10 hold period is achieved, the asset is marked up to fair market value, so there's no recapture on that depreciation. This really is the major benefit for opportunity zone funds that has been overlooked, and we're really driving that home in this presentation. Now, if you're looking at a 1031 exchange versus a QOZ investment, this is important information. 1031 exchangers are always looking to defer taxes. They even say defer, defer, and die. Like that was the terminal event, pun intended, that would prevent taxes from being paid. But in an opportunity zone, we have much different scenarios. So in a 1031, you have like-kind property, 45 days to find the replacement property. The accommodator's holding your money. You have to reinvest all your proceeds to match debt. You get a tax deferral, but there's no additional depreciation. You just get your transferred basis. And then your income is then taxed excessively without having the depreciation. And of course, you either have to pay recapture when you sell, or the death would be the way out of that. In a QOZ investment, you can invest real property, business interest, stock sale, capital gains. You have 180 days to invest, or up until the end of this year from anything that's occurred previously in the year. You can hold your money instead of the accommodator until you make the investment. You only have to invest your capital gains, which means your basis is there. You can keep any of your basis, put that money in your pocket. You receive tax deferral, tax discount, and exemptions that aren't available in a 1031 exchange. You can increase your depreciation by adding qualified non-recourse financing. No additional cash out of pocket, just add more debt. Depreciation then shelters your income, and of course there's depreciation forgiveness, as we mentioned before. QOZ investment is far superior. Now, financing is one of the major changes that has happened since COVID. The cost of debt, we just heard that in the last presentation, it has come way, way down. And for some projects, HUD financing is available. 223F normally requires 3 years, is now a 6-month seasoning, and the current rate that we're quoted was actually lower than this, 2.45, with a 25 BIP mortgage insurance premium is a 2.7% rate. That's about 150 basis points than what we were seeing before. And there's a 35-year amortization and a 1.176 debt service coverage ratio. We're seeing 10 or 15% more debt that is available on a property and still a lower cost to service the debt. There's additional equity available through the PACE bond program. We talked to a HUD underwriter. It's a 25-year bond for eligible improvements, and the HUD will allow it up to 92% LTV, which massively reduces your equity requirement. Now, qualified opportunity zone business is the entity that operates below the opportunity zone fund, and it only is required to have 70% of its assets in an opportunity zone and 30% outside the zone. So you could select high growth, high income locations for those 30% outside investments to boost your returns inside the fund, which is exactly what we're doing. Also, you can use a land lease to lower the basis for the asset test. So instead of buying all the assets outside of the Opportunity Zone Fund, just buy the building, which you can depreciate, don't buy the land. You could also partner with other Opportunity Zone funds and other QOZBs at the QOZB level and share fees. So it's very creative. Now, if you're looking at REITs versus LLCs for an Opportunity Zone Fund, it's important to note that it's easier to hold a REIT, it's easier to sell it. You can time your 10-year hold exactly. The underlying asset is not the key, it's the how long you hold the investment. But it's structured like a C Corp, so you can't get all those depreciation pass-throughs, but the simplified reporting is a plus, and there is a possibility of reducing your taxes by 20% with the 199A deductions. These do phase out with income, higher income. Now, an LLC, which most of us are familiar with, you would be able to receive depreciation. Some of these can be huge non-cash losses that are passed through for tax savings through your K1, and you'd have to have a separate K1 for each state, but most people are used to this. Now, also, an interim exit before the 10-year could be accompanied by depreciation to offset all that income, which is exactly what we're focused on. Now, we have a fund with the primary fund asset is Acqua Apartments. It's a 100-unit Class A multifamily building, just 2 blocks from the downtown waterfront, and it has a 132% of median family income because the area has been growing like crazy, and the opportunity zones were set up using 2010 census data. Since that period of time, this area has been growing like crazy. This is a newly constructed building. It's considered original use, which means even though it's a completed building, it gets all the benefits of the opportunity zone, including depreciation deductions in the first year and operating deductions. The building's currently in lease up in the downtown Portland area. This fund also has a pipeline of optioned properties. Southeast 18th is an example. It's 59 units. Permit is already issued. This would create bonus depreciation when it's completed. It does have an affordable housing component to it. It receives a 10-year property tax abatement, and it's also in a better income area, 118% of MFI, but does have that benefit of getting the 10 years of tax abatement. We also have some other assets shown here where the planning is currently in process, and they're rapidly growing areas. Now, I'm the fund manager, and I've got 31 years of experience in all matters of real estate development. Harry Siebold from Siebold Construction actually built the building on Acqua with me. He has thousands of completed projects. He's an investor in the project, and we'll continue to build the other projects in the pipeline. We have additional partners for compliance, property management, legal and tax advisory, and government financing. We have unique investment benefits, 1% asset management fee for the first 10 years. We will allow investors to stay in longer. That's the flexible exit scenario. And we are providing 100% pass-through with no preferred return. This allows the depreciation to flow through, the operating losses to flow through, and the fund plans to pay a distribution to cover, or will attempt to cover, the 2027 tax payment that would be due with adequate distributions. Now, what happens with internal rates of return by having all of these tax benefits is incredible. We're using Oregon state tax rates, looking at a pre-tax IRR of 11%, and you'll notice that it's a 21% after-tax return. The equity multiple is higher, so you can see that you're making more money off of the taxes. You're saving money on taxes using tax savings from other income. If you hold this property for 27.5 years, we just wanted to show what it would look like. There's a higher after-tax IRR, and you'll notice the equity multiple goes down. It's a little lower because over the course of 27 years, you'd actually end up paying a little more tax than the benefits because of the growth. But still, a 27-year time frame to own a property means that all of the depreciation can be received and forgiven, and all the capital gains that would normally be due would also be forgiven. There's nothing like it out there. Now, cash-on-cash returns are also incredible. 9% pre-tax or pre-sale pre-tax turns into 24% after selling the assets. If you're looking at post-tax, 12 and 26%. These are very high rates of return. You're making a lot more money off of the tax savings. And the 27-year returns are also very high. Could you imagine owning something and after-tax returns over 27 years being 26%? That's what's available in certain situations with opportunity zone funds. Now, a 1231 property gain, this is really interesting. When we first put our fund together, we looked at what is possible if you have 1231 property gain and invest it, and you're at a 33.5 or 33.7% rate, you'd receive right up front for $100,000 investment of $33,700 tax savings. And then cost segregation, about 25% of a building would typically be cost seg, 5 and 15-year property. So we used a 25% cost segregation amount, and at a 50% rate, it's about a $12,500 tax savings. Then there's the operating losses through the lease up. And then the 1231 property loss, this is the real interesting part, is that if there was an offsetting loss that was not used because of the new changes, this could be used for other ordinary income tax savings, and the total tax savings from the first year of investment would be $101,000. Okay, this is what we saw. We looked at it. We checked it with our attorneys. Polsinelli chimed in, said this is absolutely real. We went to all of the other compliance people that said this is absolutely real. And what we're saying, and what I'm really promoting, is that everyone that has an opportunity to create a 1231 loss or any other kind of net operating loss, take advantage of the ability to go back 5 years and get your taxes back. Now, we have reinvented our fund. This is the 1231 property gains reinvented. What we've done is we've decreased the amount of equity that we need up front by using more debt, using the HUD financing. So we have increased the amount of cost segregated bonus depreciation. In this case, the tax savings using Oregon rates would be $35,000. And you can see the total tax savings in the first year if you have offsetting 1231 property losses to save taxes, $124,000 of total tax savings. Absolutely incredible. This is real. We've checked it out. This is our disclaimer. We don't provide tax advice per se, but this is what we've found and we've checked it out. We're happy to talk to your tax advisors to strategize, come up with ideas. We really enjoy the process. And then we do have a fund. The fund is found at QOZB Portland. It's called Acqua QOF Portland. You can reach me at this phone number or this email address. Thank you, everybody, and we're open for questions. Hey, Michael, can you chime in for the questions, or do you want me to go to the Q&A?
Yeah, there's some questions with regards to a gentleman wants to know if you'll be willing to share the presentation on the Opportunity Zone information with him.
Sure, happy to do that. Okay. Just email me at that email address that's on the screen.
Okay.
We did cover a lot of information there on a lot of different subjects. And one of the main things that people are asking is can I take advantage? If you want to know, can I take advantage of it? If you have a capital gain right now that you owe tax on, and you might even be writing the check today because this is tax day, my suggestion is to put an extension in. You can extend, and you have until 12/31, that's December 31st of this year, to make an investment in the Opportunity Zone Fund. And you could use that against your 2019 capital gain tax. Then you'd be receiving the depreciation for 2020 in this case, because you're investing in 2020 and we're passing through those losses for 2020. Okay.
So we also have a question coming from Frank Sterling. The tax advantage calculation you show is only for an active investor. Is that correct?
Yes, that we're assuming they're an active investor, and there's other circumstances that may allow it, like the 165I, you automatically get those. 1231 losses are automatically considered ordinary. So the depreciation component, carrying it back and using that, is considered to be active. That is correct. But let's just go and take a look at that really quick. So in this slide, the 35,000 would be active. These other ones seem to be fairly attainable without being active. So if this 35,000 for the bonus depreciation was passive, it would be suspended. So for folks that have maybe a non-working spouse that can qualify, just the 2020 year is necessary, and then all of the past years of passive investing, you can take the NOLs back. Does that answer the question?
Yes, it does. There's more questions that are coming in as well. Would you like me to?
Yes.
All right. So do you need to be a QP or just accredited investor to invest?
Yeah, accredited investor would be fantastic. Yeah.
Okay. If I'm out of state investor, say California, how would the tax deferred number change?
California taxes would still be due because there is no compliance, but there's about 17, maybe 19 states that are in full compliance or at least partial compliance with the opportunity zones. And so in California, they would just be adding your state tax to that. And then
Okay.
before you sell, you could move up to Portland and join us here in the #1 opportunity zone.
There seems to be an issue with Lane's email because I just tried to email him. It says,
We'll get that looked at. You guys give us a few
Okay.
hours to get that solved.
just to confirm, if I sell a property with partners XYZ and do not proceed to a 1031, same title, can I take those proceeds and invest within 180 days? Example, I do not need the same partners that are on the title of the sold asset.
We're getting pretty technical. Your portion of the gain that would be passed through your proceeds, you would have debt and you'd have cash. You would also have basis. You would look at your basis and then invest the difference between all of your proceeds and the basis into the Opportunity Zone Fund. That's the way I understand it. And it would not require your other partners to be involved.
All right. Can you restate how the depreciation is received and forgiven?
Depreciation is received in a K1, and the K1 passes through the depreciation each year. And then at the end of a 10-year holding period, the partner at the partner level would exclude income by using the Opportunity Zone markup to fair market value rules. And by doing so, you would also be able to exclude the recapture income. So right now we're focused on depreciation as being the primary benefit, because each year you get depreciation. Upfront cost segregated bonus depreciation for 5 and 15 year, and then each year you get a piece of the 27.5 year, or maybe 30 year, 39 or 40 year. But in a multifamily asset, it's typically 27.5 year, which is about the total time that you could be in an Opportunity Zone fund. Okay, kind of added some extra info there.
All right. So Lane, we are just about out of time. Are there any closing comments on how to get in touch with you? Anything that you would like to share with the audience today regarding this opportunity to wrap?
Sure. Please go to the QOZ Portland website, register there, and try us at our email address. We should get that resolved. Please take down my phone number. You can text or call me at that phone number, 503-970-4276. And then if you have any fund structuring or investment ideas, I really enjoy talking about them and strategizing. It gives me ideas and it gives others, and I'm here to help anyone that I can. Okay, thanks so much, Michael.
No, thank you very much. Thank you very much. And I'm going to take back the screen here.
Okay.
So if you don't mind just stop sharing.
Okay, stop share. Got it.
Perfect. Thank you, Lane. And
Thank you.
congratulations on the QOZ and
you.
the market that you chose. It has a lot of compelling reasons to, to look at it today. Thank you for your presentation.
You bet. Thanks so much.
Okay, so I am jumping into the presentation again here, and I am going to project my screen. Thank you. Thank you all for joining us, and thank you to Lane Lowry for doing his presentation today. It was obviously from somebody who knows this stuff inside out, and a lot of the details that that I heard over the last like 90 days. He was the first one to mention them to me. So he has a passion with this tax efficient structure. I would like to thank all of our members for making this 5-part series possible. We are in the midst of once in a lifetime economic situation, health situation that I believe will be in the history books and will be discussed over the course of history. This 5-part series has had over 200 different speakers, somewhere in the range of 750,000 minutes of live watch time. And, this whole conversation that's been generated during the pandemic would not have been possible without the support from our members and the participation from each of you. So I want to thank you all for being a part of this conversation. And, I really am trying hard to bring you, experts and observations from the front lines and different points of views, whether it's investors or managers or service providers, what they're seeing, so that we can facilitate coming out of this situation. Tomorrow, I'll be doing a presentation on our special situations marketplace. We have a real estate and direct lending and private debt forum part 6 starting September 10th. That's the one that, it's the fall series. We hope that you all sign up and register for it. We'll be sending the registration link through the chat function. I want to encourage interactive Q&A through all of these sessions. We have some upcoming digital webcasts, RLA, Revolution Leasing Administration. They do the leasings on Bitcoin mining, and they have a really interesting principal protected model to generate passive income. Nationwide is doing a webcast on July 22nd at 1 p.m. They have a product called NUSI, NUSI is the ticker symbol. It's an ETF, publicly traded, and you should take a look at it. It's an excellent product. Lloyd Jones is doing a presentation on the 23rd, investing in senior housing post-COVID-19. It's a once in a lifetime opportunity to look at senior housing and the opportunities that are present today in that space. It's incredible. The macro economic drivers in this particular space are going to continue for the next 20 years. And anybody that's interested, now's the right time, because you won't find deals like you're finding now today. So Guillermo Bowder from Clarion Asset Management has been involved in global EM bonds and buying them, investing in the space for over 20 years. He's a brilliant guy. He's going to be doing his webcast on August 18th. I suggest that you register.